Rohr here with an early global view video analysis on Monday, July 7th, 2014. It's currently 7 a.m. U.S. Central Time, and it's important to consider in the wake of the long U.S. holiday weekend that on Thursday we had pretty much weak data everywhere else before that strong U.S. employment number. And in fact, we had a just slightly worse than expected ISM services as well. And that sort of theme, and maybe the reason why the U.S. is the outlier upside leader for the equities, is apparent again this morning, where we see that German and Spanish industrial production were quite a bit weaker than expected. That was following a weaker than expected Japanese leading indicators. The one high spot is Eurozone Centix investor confidence. That was a bit better than expected, but what's interesting is that there is no U.S. data today at all. In fact, in a classical fashion, the week following the release of the U.S. employment, where we've already seen the various PMIs, tends to be a fairly light week, and that's the case this week, so the focus will be elsewhere. And in terms of the market activity, we have the short-term view of the S&P 500 future up in front of you right now. And in fact, it's trading approximately $4 lower, back down at 1973.5 after the push up on Friday that took it to the new all-time high and allowed it to finish up at about 1977. Now, this is important because last week's top of the channel on the weekly chart was about 1971, and this week's top of that channel is about 1975, and that's consistent now with oscillator resistances. So the fact that it's starting the week back below 1975 could be a bit of a cautionary sign, but the two things we'd say right away are, number one, is it weak enough, especially timely this morning, to stay weak below 1973.5 or so for a couple of hours that would take it back down out of its aggressive upward channel that it held during the sideways churn on Wednesday before the strong number helped push it higher on Thursday. And two, is it weak long enough this morning to put the hourly MACD back below its upper runaway band? Of course, getting above that as of the, well, it would be mid-morning on Friday, but that was also into mid-session on a trading day that ended early, right around 12 o'clock U.S. Central Time. So those are the two things we'll be keeping an eye on. If indeed it can escape to the upside, then the next oscillator resistances are not until right up into levels like 1995 to 2000 now, looking out at where the bigger levels would be coming in this week. And with that, that's really pretty much it for the short-term view of the S&P 500. Moving on to the intermediate-term view, what we have is a view of that major topping line on the weekly chart. As we mentioned, it's right up around 1975 this week. Okay, let's say it's specifically more like 1976, but that's only a dollar difference. And as you can see, the 41-week average is right up around 1840. Especially if the market pushes up a bit further, that'll tend to drift up right toward 1840. $135 above, 130 to 135 over tends to be the oscillator resistance. So you'd be talking about, of course, 1970 to 75 as oscillator resistance as well. And that's why the market could tack on, the next 25 or 30 bucks, right up around 1895, 2000, 2005 even, if it can maintain the overall upside momentum. So with no U.S. news, or very light U.S. news for a couple days, it's going to be very interesting to see if the upside leader can continue to lead. On the downside, of course, the lower supports are back into the gap higher from Friday, right back into the 1968 area. And after that, the overrun resistance from back around the mid-1950s is going to be very important as the key support now, because there was also so much congestion put in general and near the top of the channel in that mid-1950s area, but most importantly, it was the downside reversal, and also there was a down break in the lead contract previous, going back into this area. There was a down break from there that all points toward this negated downside reversal from a week ago Tuesday at 1953 area as being very key if the market should indeed slip back out of the 1970s. And that's pretty much it for the intermediate term view.